welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on US retail stocks, and our guest is David Sekera, the Chief US Market Strategist at Morningstar. Well, after a lackluster start to the year, investor interest in retail stocks has accelerated. The S&P Retailing Index is up 21% this year, but 10% of that is just since the start of October. The reason why? Retailers are playing catch-up. The answer is unsurprisingly linked to the economy. Official data out on Tuesday showed core US retail sales, excluding things like autos and food services, increased a more than expected 1.6% in October, as Americans started their holiday shopping early to avoid empty shelves. But as this sector is a motley crew, not all are as well positioned to capture this demand. This index includes e-commerce giant Amazon, home improvement retailers, auto dealers, discounters and department stores, while it excludes the likes of Walmart and Costco, which are lumped in with supermarkets even though they sell everything from clothing to TVs. So, how can investors position themselves to take advantage of this recovery? Let's ask Morningstar's David Sekera. David, hi. I know Morningstar has just released its own forecast for the fourth quarter. What's your headline prediction and how will it affect retailers' bottom lines?
Hey, Elena. So yeah, we definitely expect a strong holiday sales season this year. And as you mentioned, it started off with a bang in October. So our current forecast for the fourth quarter for total retail sales is 9.5% as compared to last year. And then when we break that down into some of those areas that are most levered to the holidays, we're looking at e-commerce sales being up 10.4%, and sales in the brick and mortar channel, and specifically those that are leveraged to holidays, and as you mentioned, excluding areas such as gasoline, vehicles, and groceries, we're expecting that to be up a relatively strong 9.1%. So really the limiting factor in holiday sales this year actually could be the lack of inventory that we're seeing across many of the retailers as transportation and shipping issues have taken their toll. Now, those low inventory levels have been well telegraphed to consumers, and we've seen parents, especially those with young children, who have started their holiday shopping even earlier this year than usual. Now, with low inventory levels, we do expect that promotional spending and discounting will probably be pretty low this year, and as a result, I would expect that both top line and operating margins and earnings across the retail sector will be really strong for the fourth quarter this year.
But I know your report says the rising tide won't lift all boats. Are some retailers being left behind here?
What it is that with the markets just generally overvalued, stock picking is becoming ever more important. And in this case, what we're seeing is that many of those stocks going into the fourth quarter have already run up to the point that we think that they're probably getting into overvalued categories. So I think to some degree, while we're expecting strong top-line sales and we're expecting strong margins this year, I think some investors are over-extrapolating that too far into the future, and those stock prices have gotten ahead of themselves. So really what I'm looking for in those stocks are looking for those where the stocks are really companies that have been able to accelerate their transition into the omni-channel. Those that have been able to balance their in-store and their online channels and really be able to efficiently manage their inventory levels between shipping as well as physical in-store stocks. So some of the ones that we're looking for that have been able to do well there would be Best Buy. And that's one retailer that we think has done a really good job of managing their store base, their online presence, and their inventory.
Online retailer's biggest player, Amazon, is undervalued in this report. That seems quite surprising. Why was that?
Well, I think the market is being a little overly pessimistic taking a look at Amazon's e-commerce growth this quarter. Of course, Amazon was one of the biggest beneficiaries last year of the surge in e-commerce that we saw as social distancing and shut-ins took their tolls. But we think the stock is undervalued. We think it's worth about $4,100 per share, and that puts it in the 4-star rating category. So again, we do forecast that the e-commerce business this quarter will probably only grow by a little bit over 6%, which would be less than the overall e-commerce category. But we think that the market is overly pessimistic regarding that slower e-commerce growth rate over the long term. In our view, we also think the market is undervaluing the amount of value in the advertising business that Amazon has, as well as underestimating the long-term growth potentials of AWS.
Well, thanks so much for that. That was David Sekera, Chief US Strategist at Morningstar. Before I go, here are some of the top stories in the retail space. Walmart has raised its annual sales and profit forecast in anticipation of a surge in demand for toys and apparel during the crucial holiday season, even as supply chain problems hit margins. Walmart has been chartering its own vessels to move goods. It said inventories were up 11.5% ahead of the busy festive season. Home Depot beat quarterly sales estimates by nearly $2 billion as Americans ramped up home improvement projects, boosting demand for tools and materials. Professional contractors have been rushing back to Home Depot's stores as they work to complete a backlog of home improvement and repair jobs that were put on hold during the health crisis. And finally, high-end Japanese toaster maker Balmuda unveiled its own smartphone on Tuesday. The 5G-enabled Balmuda brand phone will cost about $920 and is designed to fit in with the company's brand image. Balmuda has carved out a niche selling minimalist appliances at premium prices, including a toaster that sells for $300 and a $500 coffee machine. And that's your roundup of the US retail sector. I'm Elena Casas, and this is Reuters.